Welcome back to the channel. This is Logan here, and today I'm going to be talking about how I lost 100 grand on an apartment deal. Have you ever wondered what happens whenever a deal does not go as planned? Well, you're going to learn exactly that today, and how a multifamily deal, fairly big one, kind of went down in flames is what it felt like. How do you keep your investors happy whenever you have a deal go down in flames? I'm going to give you 3 things that I learned about this project and how you can keep your deals from going down in flames as well. This is the deal that I bought last year, and it was a 77 unit apartment complex. It is still a 77 unit apartment complex, and this thing was a dump. A dumpy diapers, right? This thing had lots of deferred maintenance, in great shape. Previous owners were self-managing, which are some of the best deals to buy, by the way. Like, it needed a lot of love and a lot of capex to get it kind of back to just baseline. And then we were going to add a little bit of value, make it a little bit nicer to try to drive the rents up, create some value so we could then go refinance our capital back out of the deal, hold the asset for long term. So we wanted to be nice. We wanted to make sure we were doing everything properly. And so that required a lot of money. How I found this deal, again, your network is your net worth. One of my friends who's an investor who I helped, a little bit as he was getting started in his investing journey. He actually kind of took off and ended up quitting his job because he's a successful real estate investor. He called me up because this was a pretty big deal. And he's like, "Hey, Logan, I found this deal. I think it's an opportunity. Would you look at it with me?" I'm like, "Absolutely." So we looked at it together. I said, "I think this is a deal, man." We negotiated the price with the sellers, and he needed some help probably raising the capital is what he thought. He's a really good operator. So that's what we did. I helped bring the capital to the table. He managed the project. He brought the opportunity, and we formed a little partnership. It was going great. We raised the money relatively quickly, and there was lots of upside potentially on this deal, but we knew that we had to kind of change the culture of the apartment complex because we had some tenants in there that we didn't really want, and we had some that we did want and we wanted to keep, but we knew that this was going to be kind of a dicey situation because when you're renovating that many units and you're doing that much construction, you're going to have some turnover. When you start going up on rents, you're going to have some turnover. And so we closed on the property. We raised the money. We raised almost $1 million for this deal. We get going. So we start renovating units. One of the things that didn't go as planned was our costs went up on us. What we originally planned to be putting in each one of the units, our cost rose, 1, because of inflation, and 2, more importantly, because we were over renovating the units. And this was one of the lessons that we learned is like, you don't have to over renovate the units. We were spending about 3 times as much as we should in each one of these units. And we were following the direction of our property manager, who they have done an awesome job staying with us and helping us get this project stabilized. And they were thinking the units needed to be a little bit nicer than they needed to be. My gut told me otherwise, but I wanted to trust the property managers and trust the people that we had hired to do their job. And so we had a little bit overspend on these units. Again, we were spending about $15,000 per rehab, and we needed to be spending about $5,000. Long story short, we didn't correct that until we were into several of the units. So that ate up some of our capital. So that was kind of the first problem that we ran into. The second thing was we really were running into a lot more vacancy than we planned. We had some people that were moving out, and we were having trouble moving in, getting people moved in because all the exterior still looked really ugly. And we had to put a bunch of siding on these properties and make them really nice. And so it's like, "Hey, come rent this renovated apartment." And the outside looks like a dumpster still. And they're like, "Dude, I don't want to rent this," right? So that was what we were kind of battling as we were going through these turns, and we were trying to do the exterior as fast as we could. If it can happen, it's going to happen, right? So what do we have? We had problems with our exterior contractor. We ended up having to fire the guy and sue him because he didn't complete the work, and we actually had to go back and fix some of the work that he did. So the exterior renovations drug out a lot longer because we had this huge pause in the middle of renovating units and are renovating the exteriors to deal with this contractor. Again, we're spending too much money on unit turns. We have a contractor that we have to let go of, so that decreases the appeal of the property because we don't have the exteriors completed. And the third thing was we just had lots of overruns on capital expenditures, right? So the increased vacancy and the capex, we had ACs that we had budgeted to go out in future years. We thought we had some more life on these assets than we did. And so they started going out, and these things are $5,000 a piece. So we had $25,000 allotted each year for those expenses, and we just had a bunch of those happen up front. So in the middle of the year, we're like, all right, we got to get the bad people out of here if we want to start leasing these units at a higher rate and making money on this. So we made a decision along with the property managers to go cash flow negative to get some of the bad tenants out are the bad apples and get some better tenants in place, increase the quality. So the culmination of all this, guys, turned into us losing $100,000. Yeah. And not only that is we didn't have the money for our renovations. The thing that we did do properly, the thing that you should do is make sure you always go into these deals with capital reserves. I see investors all the time. They're coming into these deals really skinny because they just want to do it. They want to squeak by and they want to come in. And I've done it in the past. I'm super guilty of this, is coming into deals. This could be a single family deal, y'all, or it could be a big mobile home park or apartment complex, commercial building, whatever it is. Make sure you have cash reserves because those are going to save you whenever things don't go as planned. And if you're doing a lot of renovations or you have a lot of changes to a property, things are going to go unplanned and you're going to have losses that you don't expect. Luckily, we had money set aside so we could stomach some of those. But what had to happen was we had to go and ask for more money. We had to do a capital call from our investors. And y'all, I'll tell you, this stalled me for a long time because I was feeling like the project was failing because it didn't go how I planned. And so that stopped me from buying other deals for a long time. And I came to the realization, wow, if this thing gets bad and let's say the investors say no, they don't want to put up more money. I have all these doubts and insecurities. And now, guys, I'm an experienced real estate investor at this point. I've bought $1 million deals. I've done dozens of flips. I've owned dozens of rental houses. I've done hundreds of transactions as an agent. Like, I am a seasoned real estate investor and agent, and I am no stranger to sticky situations or situations that are tough. And this deal had me so stressed out. Because I was perceiving it as a loss because I wanted so much to perform for our investors because they put in their capital into our deal because they believed in us and they believed in the project. So I was feeling like we were losing. Well, once we actually brought this all to the investors, they were kind of taken back at first, but they actually all came alongside us and were like, hey, we still believe in this project. We're still happy to be a part of it. And guys, we know we've made a bunch of way and we're going to figure out a way to move forward. And we know we have the right team because you guys didn't shrink back and you guys didn't start placing blame. You guys came to us with solutions. And so that is something that, as I learned, is like your mindset around deals is way more important than the actual deal. Your mindset around the tough conversations you have is way more important than the actual conversation. So going backwards is not going to help me. Shrinking back and not doing other deals, if this deal was a total disaster, wasn't going to help me. But when we're in fear and when we're in scarcity, we make decisions out of those emotions instead of out of our future. And I want you to make decisions about what your future looks like, not what your present circumstances look like. In the Bible, which I believe in, guys, I'm a follower of Christ, is that it says that faith is the substance of something not yet seen. That means that we're taking actions on something that we haven't seen yet. We can only see it in our minds, but the physical fruition of it hasn't come yet. But we're still taking actions as if it is in place. That is literally the essence of faith. That's the definition of faith. So I want you to leave this video, if you take nothing else, knowing that your faith should be propelling you forward, not your circumstances. So back to the deal. Here is the 3 things that I learned from the deal. Raise more money than you think. This project, we thought we had enough money raised. We should have raised probably an extra 100,000. Things are going to go wrong. It's easier to raise the money on the front side of a deal. It's easier to ask from your investors on the front. Yes, the returns might not look as good when you add that extra capital into the deal, but you would rather have the money and not have to go back and make a capital call like I had to do and be able to finish the project. And then if the deal goes really well, then you can just surprise them with better returns and they're excited. What we did was we didn't raise enough money, so that bolstered the returns a little bit. And then we had to go ask for more money and then reset the expectations on the returns, which is never fun. Now, saving grace in there is these guys all have money in the stock market and the stock market wasn't really doing well. So the stock market was doing pretty poor during this time period. So us going from a 20% return to, let's say, a 15% return was still better than them losing 20% in the market, right? So even in this deal was a total disaster, guys. Like this thing, like if it could go wrong on this one, it literally went wrong. We spent more money on renovations. We had unexpected CapEx. We had higher vacancy. We had a contractor we had to fire and sue. Like all this stuff went wrong, and still we're going to make money on this deal. And still these investors are going to make a better return than they would make in the stock market. And they get tax benefit from this deal. And we get tax benefit from this deal. So real estate is the apex asset. You're going to have people tell you all kind of other stuff like the stock market and options and Forex trading and all this other jazz, digital assets. Guys, There's nothing better than physical, real, hard real estate. It's the apex asset. It's the best thing out there that you can own. Maybe Bitcoin, but we won't get into that today. It's the best asset you can own because it has all these benefits that these other assets don't have. Have a larger margin for bigger rehabs. This is the second thing I learned. Have a bigger margin the more complex the project is. So one, raise more money than you think. Two, the more complex it is, put more margin in your numbers. The more complex the rehab is, the more units you're rehabbing, put more margin in for that complexity, right? So you should increase the buffer percentage. I normally go with like 15%, whatever my costs are going to be. I'm like, all right, I'm gonna put 15% lump. The more complex, the bigger it is, the more buffer you need to have on there. And the negative side of that, guys, is sometimes it means you're not going to buy a deal because you're being conservative. But it's better to not get in a bad deal than to skimp into a deal and not be realistic and it turned out to be a bad deal because you weren't conservative on the front side. I would rather pass on a deal that was okay and wait for the really, really good deals to come around. The third thing is setting proper expectations with your investors if you're raising money. Guys, setting proper expectations is everything. What I did was I told them that there was a possibility that we would refinance this deal and get all of their cash out. And that's what they were looking forward to. And that possibility still exists now, but because of the stuff that we had go on and us having to raise a little bit more money, it's probably, and the market's gotten worse on us, it's probably unrealistic that we're going to get all of the money out, but maybe. I wasn't clear enough up front that that was just a possibility. And I needed to be more direct and more assertive in saying, hey guys, this is what we're shooting for, but this is not what we're planning for. And setting proper expectations up front, because that was their biggest letdown, was like, hey, are we going to be able to get all our money back out of this deal? And, a couple years like we had planned, and it was like, well, maybe, maybe not. And so that shift of expectation was the biggest negative and downside for them in this whole deal. So I hope this was helpful. This is how you lose 100 grand, guys, and still have happy investors. They weren't super overjoyed that they had to put more money in the deal, but we did such a good job, setting this thing up for success and buying it at such a good rate. We're still going to make money, guys. We have great debt on it. We have time on the debt. We have all the pieces and puzzle for this to turn out to be an awesome outcome. And so our investors are looking at their other options and saying, man, this real estate deal, even though it went nowhere near plan, it's still pretty awesome and it's still outperforming the other stuff that I have going on. Awesome content here. I hope you guys like this content. If you did, if this was helpful, leave me a comment and let me know. If this was terrible and you hated it, let me know that too. I would love to have feedback and get better at this. I'm used to talking and used to shooting videos, but not used to doing it for YouTube. So I'm learning here. So I want your feedback, guys. And if you want to connect with me, go ahead and reach out. I would love to talk to you. If you have specific deals that you want me to underwrite with you or look at or review or partner with you on, I would love to do that as well. But the first thing you can do is subscribe to the channel and go ahead and click that bell so you can be notified when I put out new videos on new content about how you can become an awesome and successful real estate investor too. Logan, out.